And the chair now recognizes himself for 5 minutes for questioning. According to the administration's proposal, the states will be able to enforce the statutes and rules being transferred to the new agency right away. In contrast, the FTC will be required to provide the CFPA with notice of a proposed action, and as has been stated earlier, wait 120 days for the CFPA to determine if it will take the case before it take any action. This applies to the very rules and laws currently enforced by the FTC. Mr. Calkins, in your testimony, you suggest that this 4-month delay will prevent the FTC from ever investigating or taking action in these areas. Can you explain and expound upon that, please?
When I read the bill, I sat and tried to think about what life would be like under the new legislation and the 120-day rule. What would the FTC do? And as I thought about it and I read the bill, I read where the bill says, quote, all consumer financial protection functions of the Federal Trade Commission are transferred to the other agency. So who at the FTC is going to be doing the work to find that there is a violation that they wish to use the 120-day rule to develop? Maybe the FTC will go out and develop new resources to do this. Does that make sense? And I don't think that makes sense, because the whole point of the bill, it appears, is to transfer a large part of what the FTC does to this new agency. Let's talk about the 120-day rules. Well, we have experience with the FTC and the Department of Justice, where the FTC can ask the Justice Department to bring a civil penalty action for it, 45 days there. The reality is that the FTC, although I'm not sure they would admit it, goes out of its way to avoid using that authority. It is a lot more effective and efficient for the Commission to go directly to court, bring an action, take action against a wrongdoer, stop a fraud, stop some harm, get relief. And so they use the authority they can use by themselves. And time and again, they don't go to the Department of Justice. I think that that 120-day authority will be very rarely used in the new world. It's really there in case we have a new agency that is so opposed to enforcing these rules that an FTC might come along and try to develop some sort of alternative world as a backstop. But I think that the world that I see would have the FTC using this authority very, very rarely, and I just do not think that is the vision contemplated by the bill as written.
Does any other witness want to chime in here? Is this shared skepticism on the part of the other witnesses? Ms. Barkow, are you skeptical of this backdrop rule?
It does seem like 120 days would be the equivalent of a lifetime in this kind of an industry where you're talking about the word financial assets disappearing.
If it was 60 days, would that make a real difference?
Well, that I leave to the FTC to decide, but the fact that they're worried about the 120 days, I think, speaks volumes about the fact that it's probably going to be a significant issue.
Anyone else want to chime in here on this?
Well, I think if you look at some of the discussion that occurred earlier, and they were talking about the number of days, but perhaps more importantly, look at the actual structure. They've taken so many of the personnel. The team has been taken from the FTC and is now part of the new agency. And yet they're supposed to maintain the backstop or the backup in these areas. But the team is gone. And as Mr. Calkins suggested, all they can do is go out and rehire new experts that are supposed to be the backup. It doesn't sound like a very good system to me.
Ms. Hildebrand?
Yes, thank you, Mr. Chairman. Under the one rule writing, many enforcers model, we want it to be as easy as possible for the FTC to bring the cases in its existing jurisdiction as well as to enforce the CFPA rules. If the Commission recommends a shorter time period, we would want you to look at that very seriously. We think a waiver process also could help there. The Commission and the CFPA could agree that for this kind of case, we don't need to know in advance, and for these other cases, we need a shorter period.
Okay, the Chair's time is concluded. The Chair recognizes the ranking member, Mr. Radonovich.
Thank you, Mr. Chairman. Mr. Calkins, the proposed legislation defines a covered entity to include those who provide tax planning, financial, and other related advisory services or provide educational courses and instruction materials to consumers. PBS often runs such programming on TV for their audiences, as do financial cable stations and radio stations. Would these entities be covered persons under the proposed legislation, in your opinion?
Certainly there is a risk that they would be covered persons. Certainly the Commission would have to think about whether it was required to transfer responsibility for all those. And then, very important, even if they are not covered entities today, the new agency has authority to define for itself additional activities that it would have jurisdiction over. Right. And so even if the FTC didn't have to transfer authority today, they might have to transfer authority a year from now when the definitions got changed.
Thank you, Mr. Calkins. Can you, I want you to comment on a prior statement about the FTC's bipartisanship and way it conducts its activities and how that's good. Can you elaborate on that and how the lack of bipartisanship might hinder the CFPA's ability to effectively carry out what is now the FTC's mission?
Well, the FTC, I think, has, over the years, developed credibility with Congress, with the states, with international observers, because it operates in a bipartisan way. The commissioners try to work by consensus. They try to take the actions that make the most sense. When somebody wants to go out on a limb and be really wild and crazy to the left or the right, there's someone from the other side to pull them back in. As noted before, Ms. Barkow, when you have people going too far, dissents can be filed. And it succeeds in developing a shared understanding of the sensible way to proceed. And then, as presidents come and go, there exists some continuity. And that continuity, I think, adds credibility to the agency's operations and really has made it into a more effective agency.
All right, thank you. Ms. Barkow, would you care to respond to that question as well?
I agree completely, and I think that the whole idea of an independent regulatory agency, which I think is part of the goal in this legislation, is to have that kind of consensus-generating form of norms that transcend any particular presidential administration, so that you don't have the instability that comes with every new presidential administration means sweeping changes one way or the other. You have a stabilizing force in an agency that has membership from both parties. I think it's proven to be effective in other contexts, and it's hard to understand why you would have a multi-member agency here that doesn't have that mix of political views on it. I mean, why not just then have a single member board?
Mm-hmm, mm-hmm. Thank you very much. Mr. Steinberg, I want to ask you about uncertainty in the financial markets, this massive shift of responsibility in the creation of the new agency on consumer protections. Your bird's eye view on the industry, how it would react to something like this, and the level of uncertainty that it might bring into the markets where uncertainty is we're trying to do everything to avoid uncertainty. Would you comment on that, please?
Well, some might argue that this is the perfect time to do something like this. I think it's absolutely the worst time. We're finally starting to see some stability in the financial markets. We're starting to see some recovery. We're starting to see investors come back into the marketplace, which eventually investors have to buy these loans out there. In Europe and the U.S., we're starting to see movement back in there. This does introduce a whole level of uncertainty back into the whole arena, because people are now going to stand back and wait and see what goes on, whether there is additional liabilities, requirements, and regulations on these entities. So yes, I do agree that it's going to bring a new level of uncertainty into the marketplace at the worst possible time for that.
Can you describe a scenario where the duplicative regulatory authorities allowed by this Act's weak preemption provision might actually prevent consumers from access to to valuable financial services? This is the state preemption issue where you'd have 51 different.
Right now, it's set up as basically a floor or a standard that states will have the ability to exceed. Someone will make a judgment whether what the state is trying to do is meeting or exceeding. I'm assuming that would be the new agency. Mm-hmm. But if a determination is made by then that it exceeds it, of course, anything that they would do to exceed would be permitted. So I think you've seen it in many other instances. I'll give you the most recent, the new SAFE Act. That was the licensing for residential mortgage originators. You basically have out there in the implementation of that law 50 different standards that everyone's trying to meet, and each of them, many of them, exceeding the federal guidelines. So people that are regulated at the state level or have to register in multiple states as originators are going to have to follow very, very many different laws.
All right. Thank you very much. Thank you, Mr. Chairman.
The chair now recognizes the gentleman from Massachusetts, Mr. Sarbanes. Maryland, I'm sorry. Oh, boy. Maryland.
We're trying to get to Massachusetts.
Yeah.
We got one Republican left. Okay. Thank you, Mr. Chairman. I appreciate the hearing. Mm-hmm. Mr. Steinberg, you said this is absolutely the wrong time. What would be a good time?
Well, I think when you go back, and there's plenty of history to point fingers at what was the cause of the subprime mortgage crisis and the currently economic crisis, but I don't think you'd get anybody that would predict that whatever is done here today, or even by Congress, that you can control every bubble that is going to occur in the future. Most economists would agree that, yes, this bubble was a housing bubble. Before it was a tech bubble. Before that, it was a savings and loan bubble. You cannot have government totally controlling financial markets unless they can totally control potential bubbles, unless you totally stymie innovation and all you have is a plain vanilla, standard product out there. And I don't think that's good for the very consumers that we're trying to protect here.
I agree with that. I mean, I don't think you can have government totally controlling every single financial dimension in the market. Don't think you can do that. I don't think this tries to do that. I think what this tries to do is provide some oversight and direction and rules of the road so that people stop driving off the road. Not only because, in the view of Alan Greenspan, that causes the drivers to crash and hurt themselves, but because they run over hundreds of thousands of innocent bystanders in the process. Let me switch back to a discussion from a few minutes ago, because I think it's very relevant. As attractive as the new agency may be to some, and I'm partial to it as it's being described, we still have to get from here to there. And I worry a lot because even if we had in place now the regulatory structure that we thought was necessary, it would have to be in overdrive, I would argue, to be on the lookout against predatory action that's lurking out there. But certainly in a transitional phase, predators have a lot of opportunities to make mischief. And I think the discussion about the 120 days kind of points to some of this anxiety. But I'd like anyone who would care to, I'd like to hear you respond to the idea of some kind of a special initiative or task force or consciousness that during this transition, we need to be paying attention to, maybe it's a limited set of activities or potential mischief, but that there's got to be a special focus on that so that we don't make the transition saying, now we got a good regulatory structure in place. But in the meantime, while that happened, a lot more people got hurt. And I say this because there's a lot of money that is flowing right now, taxpayer money, into the financial infrastructure of the country. And many of the same players that took advantage of people over the last few years are thinking creatively of ways to take advantage of them again by accessing some of these dollars. So speak to that issue of how we can not be caught napping during the transition. We can start with you, Ms. Hillebrand.
Thank you. I believe you're asking exactly the right question. There will be a danger period during the transition. There are a couple of things, and I don't have the whole answer. One is the work that the FTC does right now and continues to do up to that date of the transfer of rulemaking authority will be incredibly important. It could be up to 2 years after enactment. If these two titles are enacted together, the FTC will get its rulemaking improvements right away and can get some of these rules that have been kind of backlogged because of the limitations on its power moving and into place. That will help, certainly, to put those policing into place. We do need to be paying attention to the new problems that will be developing. One that worries me in particular is a new form of zombie debt. You know, that's the debt where no one's got the paperwork. Someone just has a list saying you owe this amount that might come out of some of these mortgage unsuccessful modifications or post kind of mortgage dispositions. So there are new issues, a lot of old issues. The more we can get the FTC to do now before the transfer, I think the better shape it will be in. But we will have to watch for that, yes. And the other thing is there's not going to be enough enforcement resources. Moving people from where they are over from all the different agencies is not going to give us enough enforcement staff to do the whole job for the country. The FTC has worked very hard. They said they had 100 cases over 5 years. If you talk to any state AG in the country, they'll tell you 100 cases, we could bring that in my state tomorrow. There's more need than the number of people that are currently in place to do consumer protection enforcement and financial services at the federal level.
Yes, sir.
I think you need to break your question, which is a great question, into two parts. One part is more scam-like activities, and I think this Congress effectively delegated to the FTC charge to go after foreclosure rescue scams, where a lot of mortgage brokers are moving in, and loan modification scams and that kind of thing. That kind of activity, the existing authority clearly is sufficient to regulate, and the additional authorities recently given help. You break that from more traditional and large-scale sale of products such as mortgages, et cetera. And I think in that area, the credit markets are so beaten down that I think that this agency would be up and running effectively to get ahead of the new products that would be.
That's helpful. That's helpful. Okay. Thank you very much.
The chair will extend to the members an additional time for one additional question, and the chair recognizes himself for one additional question. I want to get back to this area of concurrent enforcement, and are there any risks or downsides to consumers or industry with this whole idea of concurrent enforcement between two agencies? I mean, can you predict or look into a crystal ball and tell us what you see in terms of downsides or harms to the industry or to consumers regarding this whole area of concurrent enforcement? Anybody want to jump in? Mr. Steinberg?
Well, I'll give it a try to go first. One of the whole things that I think the agency being proposed is supposed to do is have single source responsibility. Then you take enforcement and you break that among current enforcement agencies, and then you have a new agency that's supposed to share some type of dual enforcement. It doesn't sound practical to me. We think that enforcement should continue to stay with the existing agencies. Now, to your question, Congressman, about the timing, and you mentioned the speed limit and people watching the people going down the road. I think that I don't think anybody would deny that the regulations or the speed limits were in place, but up until several years ago, that perhaps the regulations were in place, but the enforcement and the oversight was not. But I think if you look today in all of these agencies, whether it be the FTC or the other agencies in Washington, I think everybody has their radar guns out and are certainly looking at consumer protection issues as well as credit and lending issues in general. I don't think there's ever been a focus in this area like there is today. And so to that respect, I think that going back to your question, Mr. Chairman, I think that it's very important, I think most important, that there be continued responsibility between safety and soundness and the viability of those companies and consumer protection. And I think it is unwise to separate those two entirely. I mean, we have gone through a good example with the GSEs of trying to do that and finding out why that doesn't work. And it would be very simple if that agency that is just concerned about consumer protection can make everything so safe that it's not really good for the companies offering those products or for the consumers themselves. There's always going to be risk in this industry that defines what it is. And I don't think you can eliminate that entirely.
Okay, you want
I think it's a really good question, and I would say that I think it's not so much of a risk as long as the rules of the game are clear. So long as you have the one agency that's setting the rules and what it is that companies have to do, the fact that there would be multiple enforcers of those rules is less disconcerting, because you'd have clear standards and everyone would know what they are, and you would essentially have this kind of more cops on the beat analogy. And so that's why you could have state AGs helping out, you could have the FTC helping out, you would just be getting more manpower, but the rules would be clear. So really the success of it would depend upon what kind of rules end up being produced from this process. And I guess I would just say that's why it works to have, for example, all the states can police Medicaid fraud, for example, and it's not a risk because everybody knows what they're looking for. And so it would just be it'd be really important for the agency that's created to have clear rules. And if they see an enforcement action that looks like it's not really in the spirit of those rules, the act as it's written, for example, if the state AG brings it, the CFPA could intervene and they could step into that action and make clear that that's a bad interpretation of their rule or it's a bad enforcement action. So I think it's okay to have multiple law enforcers, and in fact probably necessary because there just aren't enough resources for all the fraud that's out there.
Ms. Hildebrand?
Thank you, Mr. Chairman. I had to think for a moment about your question to remember that there already are 6 concurrent enforcing authorities. It's just that the banking agencies haven't used that open public enforcement model to bring cases with the vigor and approach that the FTC has used. So we already do have concurrent enforcement, and the downside has been that many of the agencies, other than the FTC, that have enforcement authorities also have other obligations that tie them very close to the industry that they regulate. We'll, at least with the concurrent enforcement authority with the CFPA and the FTC, we won't have that problem, and I think that's a good step forward.
Mr. Colgan?
Mr. Chairman, I think that concurrent enforcement authority could work if done carefully, but I worry that there's too much attention to the FTC as an enforcer. I prepared for this over the weekend when the website was down, so I was reduced to the documents that I happened already to own. I owned a 2004 annual report. It happened to be in my files. I opened it up to Consumer Protection, where the FTC has a good list of the range of activities in which the agency engages, and that is part of what makes it a success. Consumer protection policy: 1, research and reports; 2, hearings and workshops; 3, advocacy; 4, amicus briefs; 5, consumer and business education and outreach. The FTC is not just a cop on the beat. It is an agency that has economists, that does competition, that does consumer protection, and uses a whole range of tools to develop expertise, to identify problems, and to craft solutions. And if a huge part of what the FTC does as a matter of subject matter is transferred out, and if the new agency has the exclusive authority to give guidance in this way, then we've lost a very great deal of what the FTC does, and I think that the consumers would be the worse for it.
Mr. Cox.
Chairman Rush, I think ultimately the industry will make two arguments about the current authority and the problems with it. The first is it's too much of enforcement. But as Ms. Hildebrand said, and as someone who spent years making priority lists, your list is way longer than you'll ever get to. And the problem with this bubble certainly wasn't bursting, was not too much enforcement. The second problem, which is more subtle or real, is an inconsistency in enforcement policy. And Ms. Barco appropriately says that this rulemaking authority, if it's clear, if the rules are clear enough, certainly will solve the problem. And I would further say with that, the CFPA is given the sufficient authority to make sure the enforcement is happening in a uniform way. But there's a second response to the inconsistency, which is unlike rulemaking, where I agree you want a unified rulemaker. When it comes to enforcement, this is where regulatory competition actually works, because you're competing to be a better enforcer as opposed to competing for a race to the bottom so that people will charter with you, which was a serious problem in creating this situation. And when you compete to do better, you are aware that if you don't do it and somebody else enforces your rule in a situation that you might get embarrassed, Madoff, SEC, you know, that when you have competitive enforcement, you have a market that essentially forces public entities to be aware of that. That actually works. And when it comes to UDAP authority, I just want to say, it's so important. The state attorneys general, and I'm patting myself on the back here because I was part of a small group who did this, we were the only ones out there screaming about and bringing these cases. The FTC was saying, and it's great because they were going after different actors, but we did one case where we got $500 million back to people with subprime mortgages, household, followed by another case where there was $300 million, and I thought that was too little, and I'd left by then, and I was the hog. So, I mean, this was a problem that if you were on the ground, you saw it. I mean, it was visceral. It was, these people are utterly out of control. The state AGs were able to enforce it because they had a different enforcement agenda. They were sitting at a different place. Regulatory competition works in terms of an open enforcement model.
Chair, now recognizes Mr. Rodalowicz for one question.
Thanks, Mr. Chairman. I appreciate everybody's testimony, but Mr. Cox, what I thought I heard was that we need multiple agencies having to do the same job to make sure that the people are doing their job, and that to me is a recipe for wasted spending. But I do want to ask you a question about I believe it was Ms. Sutton who was here earlier, talked about a situation where an 84-year-old woman who owned her place free and clear was duped into a 30-year mortgage. I'd like to know whether or not there was family involved putting her up to that, and that happened for reasons that wouldn't have anything to do with this current financial crisis, but I happen to represent Stanislaus County in California. It's the epicenter of mortgages, frequently the #1 county in the nation where mortgage defaults and foreclosures have happened. So I have a great appreciation for what's happening here. And you'd hear tales about one in particular, non-English speaking people that were talked into a home that all they needed to do was come in and sign the papers. Once they got there, they were jammed with points and fees that they knew absolutely nothing about and were put into an uncomfortable situation, signed the mortgage papers, later lost the house. So I'm curious to know, after we have spent, in reaction to this financial crisis, anywhere between $800 to $1.5 trillion to stimulate the economy. We get we get a rise in the unemployment rate that we're supposed to drop. With all that spending, I'm a little leery of broad sweeping reactions to the problems that we're in. So how does something like this, and I'd offer that to you, Mr. Cox and Mr. Steinberg and anybody else that wants to respond to this thing, how would that help the person? I'm not sure about the Sutton case and that. I want to know whether the family put them up to that that poor, unfortunate elderly person up to that situation. But my situation in Modesto, California, where the non-English speaking person was jammed into that loans and the shyster put points on there, and then they quickly sold the mortgage to somebody else, and this guy was washing his hands and he was out of there. How does this broad sweeping change that you're talking about prevent something like that from happening? And at what cost? Any more so than what is currently on the books to prevent?
Thank you, Ranking Member Radonovich. I will respond to that by also responding to Mr. Steinberg's earlier comment, that we all agree that the regulation was there, it was an enforcement problem. We don't all agree on that. And here's, the problem had two parts to it, if you want to break it into its grossest problem. The first part was the type of products that were being sold. They were simply way too high risk, way too complex, and way too aggressively sold for average consumers to work through all the problems and understand all the costs and consequences in the context of these mortgages. For instance, the great held up at the time as the great financial innovation, the payment option arm. It was sold so aggressively on its benefits, but its risks were not clear to the average consumer, to my aunt. You know, it was the kind of thing I could have sold her on if I was an evil person without informing her of the risk. So there's a product regulation problem that existed here. The Fed, if you read the Fed's papers during this time and you put them right next to the industry's papers, you could change the titles, you couldn't tell the difference. There was one type of thinking. That needs to change. The second problem was a fraud problem. The fraud problem got so far out of control. I've never seen anything like it. You know, if you were at the level, you were talking to the people and you saw what's going on, if you talked to the ex-workers in these agencies, et cetera, and these companies that were selling these things, fraud was so rampant in this industry that, that was almost a separate problem from the product regulation problem. And so we also had a lack of enforcement, particularly at the federal level, on that, on fraud, but we fundamentally had a product regulation problem. I hope that responds.
Mr. Stein.
Commenting back to Mr. Cox's earlier discussion about whether we should have multiple regulators is a good thing. I ask you, if you're a business and you have multiple regulators and 2 and 3 regulators, is competition really good if you're the regulated entity and the costs that are involved in that? I mean, so the FTC is in your office one week and asking and having your staff gather everything else, and the next week, another regulator's in there. I can see where there might be some contention where that is good, but you won't have businesses that anyone that operates a business, small profit or a large business, which think of having multiple regulators and enforcers coming into your offices is necessarily a good thing, because and all of those costs are eventually passed on to consumers. These do not happen in vacuums. So yes, there are protections, I think, that need to be in place, and you're absolutely right about that. But I do think you can overdo a process too. We want to have a process that protects consumers but is efficient for everyone involved, that it's efficient for the safety and soundness and the viability of the companies that are being regulated, as well as good for the consumers that are buying their products. And I think that that's an important thing.
I'll just say thank you.
What's that?
Thank you, Mr. Chairman.
Yeah.
He's asking for
The chair recognizes the chairman emeritus, Mr. Dingell.
Chairman, I thank you for your courtesy. This question to Gail Hillebrand and to Professor Calkins. What authority will remain in the FTC to protect the consumers after the administration's plan has been adopted, if it's adopted in its current form?
Thank you, Chairman Emeritus. The FTC retains all of its authority to bring Section 5 enforcement, subject only to a staff-level consultation, coordination, and discussion.
So it would lose that authority?
The FTC retains that authority. I'm going to give you a list of things it retains.
Okay.
It retains its Section 5 authority. It retains its authority to bring cases under the statutes and rules for the enumerated consumer statutes. That's our alphabet soup: ECOA, EFTA, Reg Z, and so on. It retains, well, those are big things that it retains. It also retains its pure fraud authority. I mean, there are financial services, and then there are people who tell lies, who say, sign up with me and give me your social security number and your checking account number, and you'll never see me again. It retains that authority. Those folks are not selling financial services. They're selling lies. It retains that authority. And we have recommended that it also be given the same kind of backstop authority that it now has currently and would have under this proposal for the existing consumer statutes with respect to enforcement of the CFPA rules. That is not yet in the proposal.
Now, what would it lose? What would FTC lose? What consumer protection jurisdiction would it lose?
Yes, the FTC would lose a jurisdiction that has been difficult for it to use, which is its important but difficult for it to use, which is its authority to develop unfair and deceptive acts and practices rules in the financial services area. I'm sure you're aware the last time that authority was used was in the credit practices rule, which came into effect in the mid-1980s.
Okay, now why should that be taken away from FTC?
If we were looking at just the FTC, there'd be no reason to take it away. But the problem is we need...
There's no reason to take it away.
No, I'm not quite
Now
finished.
let's just go a wee bit further and explain to me why we should give it to some of those good-hearted folk who led the fight for the repeal of Glass-Steagall, who deregulated banking and financial services, and who left us this glorious mess, which we now have in the form of probably the biggest depression that this country has had since 1929. Now, why should we do that?
We need to give that authority to an agency that can make one set of rules that applies to the bank provider and the non-bank provider. If the
I have no objection to taking care of the bank regulatory agencies. Let them create them, and let them do their thing. But why wouldn't we want the honest men and women at FTC looking over their shoulder, and why wouldn't we want them looking over the shoulder of those good-hearted banks and financial folks and MBAs up in New York that created this mess? Now help me. Why wouldn't we want that?
We definitely want oversight. We want someone who can look over no matter
Do you like the
what
idea
kind
of
of...
having the FTC sort of keeping an eye on those people?
We like the idea of having an agency that can look at everybody, not just the non-bank providers, keep an eye. And we think the best way to do that is to put it all in one place.
What about the good-hearted banks that are going to be engaging in all kinds of things? They're going to be engaging in real estate. They're going to be engaging in issuing of bonds and securities. They're going to be engaged in all kinds of wonderful activities on derivatives, which are really gambling devices. So why shouldn't the FTC retain its continuing and ancient jurisdiction over keeping honest men honest and maybe occasionally catching a rascal? Now, why should we take that away from the FTC?
Mr. Chairman Emeritus, I would respectfully suggest
you represent consumers. Why shouldn't we just leave FTC as it is and let these other folk go about their nefarious business under the kind of weak-minded regulation that the Treasury has traditionally given to these institutions?
We're absolutely in favor
of... for that. You're speaking here for the consumers, and I'm trying to figure out, do you really understand the consumer's needs, or are you engaged in perhaps disregarding the consumers because these other folks have done a better job of telling you what a wonderful job they're going to do after they have brought about not one but two depressions?
I'm looking at it from the point of view of the ordinary person who's trying to get a mortgage, and they want to know. I mean, the consumer doesn't think it's TILA, RESPA, it's sales practices, but there's no federal rule on that.
But it's to the wrong question. Answer my question, please.
The answer is we think
why should we not keep FTC in its traditional jurisdiction of protecting consumers. When I was a boy, Roosevelt tried to give FTC jurisdiction over the stock market. And you can't imagine the outrage that this generated in New York because they were scared to death of the Federal Trade Commission, which is under jurisdiction of this committee. We keep them honest. And we find that as soon as the SEC got away from this committee, they all of a sudden became a wholly owned subsidiary of the securities industry and the banking industry. Now, why should we sanctify that by stripping the consumers of the one remaining protection which they have, the FTC, in favor of giving it to a congregation of folks well known to be influenced by some of the worst scoundrels in our society?
Are you ready for my answer? We believe that we need to put it in one place so that the non-banks aren't saying, "Oh, don't regulate us because the banks can still do that." And the banks aren't saying, "Oh, don't regulate us because the other guy can still do it."
We don't mind having this agency that would be created by the administration's proposal do that. What we want is to have the FTC there so as to sort of watch over these people and let them know that there are honest men and women watching them so that the rascality is diminished and the consumers are protected. What's wrong with that?
I think we have the same goal and perhaps a difference of perspective about how to get there. We think it would be difficult to get there without having one agency.
Are you telling me that you like the idea of having the FTC continue its jurisdiction while these other good-hearted folk go about their nefarious business?
We have endorsed full retention of FTC enforcement authority, but we think you've got to put all the rules in one place.
We have talked about what FTC is going to lose, and you are apparently advocating the losing of it. I am not of a view that maybe we want FTC to lose that jurisdiction, and maybe we want FTC to be around to sort of provide a minor dampening of the rascality which is going to continue to occur in the financial services industry. Now, what is your objection to that?
We believe that if you need to put the rules...
In just a few words, what is your objection?
Put the rulemaking in one place so that it's very clear whose job it is, and then you can hold them accountable to do it.
They arranged that one-stop shopping when they moved this whole thing across the hall. And since then, the whole financial services industry of the United States has had to be bailed out to the amount of $700 billion, which was congregated by Mr. Paulson, who came from that industry, and which has done nothing but enrich the same rascals that caused the trouble. And it has not only enriched those rascals, but it has given us something new to think about, and that is it has seen to it that they've had the funds to pay the same scoundrels who made the mess enormous bonuses amounting to as much as $165 million in one instance. Obviously, this is the product of one-stop shopping, which I suspect you are telling me you support, or maybe you want to tell me now you don't support.
We're trying to end the ability to shop for your regulator by having one entity write the rules, no matter what kind of charter or what kind of provider. That's our position.
Well, I have to say, I think somebody else wrote your statement, but I thank you for your presence, and Mr. Chairman, I thank you for your courage and ability in bringing this event about. Thank you.
The chair thanks the chairman emeritus. The chair thanks the witnesses. This hearing is now stands adjourned. But before we adjourn, I really wanted to let you know how grateful we are for you to extend your time with us and spend your time with us. By unanimous consent, I request that members submit all questions to be sent to the witnesses for the record within 7 calendar days, and the witnesses will respond promptly to the questions that are submitted to them. Thank you so very much, and safe travel.